Brings us to some global perspective now. Marc Faber, editor and publisher of the Gloom, Boom and Doom Report, joins in with his thoughts on global markets. Marc, morning. Thanks very much for joining in. How do you read the next 2 or 3 months for global equities? Is it going to be a period of turbulence, or do you think liquidity will smoothen out the rough edges?
Well, I think that there are people who have extreme views, either extremely bullish or extremely bearish. I think we may be kind of in a trading range whereby first we may go down somewhat into October, November, and then rally again towards the end of the year. I think the difficulty is really what to do with money when interest rates are essentially at zero on US dollars. Then obviously people look at their portfolios and they see stocks that have dividend yields, say in Asia, Singapore, Thailand, Malaysia. You can have stocks yielding, say, 5% on their dividends. So the money flows essentially into these stocks.
When you say a difficult patch in October, November, do you see those S&P levels of 1,040, 1,050 being violated, or more or less the market to find support around those kind of levels?
Well, we touched 1,010 as a low point, and then we traded several times around 1,040, so there is some support there, but I wouldn't bet that it's not going to be broken on the downside. I mean, the fact is simply the economy is not doing well, and it is very likely that they will have more monetary easing and further stimulus packages. And I'm not sure that the stock market will take that well. Maybe the stock market won't be very happy about additional stimulus, more interventions into the free market, and so anything could happen. But let's put it this way, I don't think that we will go and break down below the March 2009 level. I mean, I think that may have been a major low, and that we will be in a kind of a trading range around this level we are at here.
And you think the trigger, the most important trigger, would be what the Fed does based on economic news? It won't be an event this time around, like something coming through from Europe or from the US?
Well, I think that what is frequently overlooked are geopolitical tensions. And as you know, the relationship between India and China have deteriorated lately. And I think we may have geopolitical events that could play a role in the valuation of assets. I mean, that's why I tell people they should have some money in physical gold.
Where does this leave the dollar for the rest of the year, Marc? Because that's been quite volatile as well. What's your outlook on that?
Well, I mean, the dollar is a weak currency, but so is the euro. So I think they'll go down both against price of gold, let's put it this way. But we had a breakout move in gold yesterday, and it's important that we continue now on the upside, not that we break down again, because then that would be a failure, and then quite a reaction could follow.
Excuse me. Sorry. What about crude, Marc? That's been showing far greater weakness in the commodity universe. Every other day it keeps collapsing down to close to $70 a barrel.
Yeah, I mean, I think that industrial commodities are not the most desirable. I think the commodities complex, which is the most attractive at the present time, are agricultural commodities, and they should move up further in due course. The industrial commodities are basically suffering from still relatively weak global demand, and I think if something happens to the Chinese economy, not just a minor slowdown, but say a more meaningful slowdown, then obviously it would have a big impact on the demand for industrial commodities.
If you were owning stocks in India today, what would you do?
Well, that depends. If all my money is in stocks in India, I would sell or bring down the position meaningfully. But if I have just 5% of my global assets in Indian stocks, I would maybe keep them, depending, of course, which companies I own and how comfortable I feel with these companies. So the question is really, how much money do you have in a market? But I think, in general, people around the world are underweight Indian equities because it's a huge country, 1 billion people, and many international portfolios have zero exposure to India. So I think that in general, if someone has no money in India, I would over time accumulate Indian shares. As I mentioned to you, I think the market technically doesn't look very good, and we may go down first before we rally further, if at all. Maybe we don't rally, as I said, maybe we are in a trading range in India between, 13,000 and 19,000. But if I had too much exposure to Indian shares, I would definitely reduce the position.
Do you see the possibility of the Sensex seeing something like 15,000, forget 13,000, even 15,000 during the course of this calendar year?
Yes, easily. We have a lot of volatility, so we can easily go down 10, 20%. That wouldn't be surprising.
Thanks, Mark, very much for your thoughts today. Thanks for joining in. That's Marc Faber from Hong Kong with a slightly cautious, not a slightly, quite a cautious view of the world. He thinks it's likely that we go down first before going up later in the year.